If you look at chapter 3, it's about plan, budget, forecast. Plan, budget, forecast. Master budget. What is master budget? Master budget is the process of preparing that year's business budget, like what's going to happen and so forth. Okay. External, internal factor can influence the budget. External is your market forces, pastel, the 5 forces. Then the internal is the company plans and so forth, company management ideas and so forth. Then you got budget in manufacturing organization, how they do factory budgeting. Okay. Then you have budgets in non-manufacturing organization. Then you got financial budget, you got budget for various departments. Then you come to flexible budgeting. Okay. Concept of flexible budgeting. Then you got variance analysis and control, which includes your static versus the flexible budget. Okay, static is called the fixed budget. Flexible budget is flex for the current period. Okay. Then you got behavioral approach and alternative budgeting ideas. So you can see this is part of planning and monitoring, which is part of planning and control. Got it? Now, moving on. The governing board of a company typically consider company's sustainability in strategic plan. The manager implement the plan through operational plan. So generally, this is the standard approach. You always have something called board of directors. Okay, so the board of directors, as you know, will then have come up with what we call they have something called strategic plan. Okay, they have something called strategic plan. From the strategic plan come your they will have strategic plan, tactical plan, operational plan. Got it? Now, this is where the idea of budget comes in. Budgets are a way to implement tactical operational plan, to make it operational. So you can see they say operational plans. Budget form part of the operational plan, it's part of the operational plan. Okay. Accounting tools that help manager plan to meet the organization goal. Where's the goal? Organization goal should be here. Are you okay in this part? So when you look at the direction of things, you can say that things are going downwards first. This is called the planning cycle. Got it? So we have the planning cycle going down. Follow? And then you have the budget and other ideas going upwards. So how to achieve the goals. Got it? Understand this difference? Okay, that's basically the idea here. So we can say, but there's 2 aspects. One is the planning side. One is the control side. So now you can see the idea of planning and control. Follow? Okay, how planning and control is achieved. So moving on. What is the objective of this chapter? Okay, after you finish this chapter, or basically at the end of this chapter, you should be able to identify the roles of operational plan. What is the plan? The budget and the forecast and the relationship between these items in strategy. So there is something called what operational plan do, what budget do, what forecast do, and how they link to the strategy. Now, where are the words budget and forecast? You already saw the word operational plan and forecast, correct? Budget, really correct? So the word forecast will be somewhere nearby here. So the word forecast is usually over here. Forecasting is usually a tactical issue that comes into the operational plan. Okay, you have to forecast the site, then you can get your budget. So you have like sales forecast, material forecast, and so forth. So that's forecasting. Develop a master budget on operational plans, previous financial results, and forecasts. So develop a master budget is usually from operational plan. You can come to something called a master budget. Now, a master budget is usually related to the financial statement. Okay, what's a master budget? A master budget usually has you got soft P one side, that's the master budget. The master budget will have these three elements: statement of financial position budget, profit and loss budget, and cash flow budget. Okay, now these are the budgets that you will see here. Now moving on, based on this, perform variance analysis to monitor, evaluate performance. So once you have the budget, then the next thing you will have is, guess what? So going down, notice that we're still going down, okay? You will have the last part, which is called you have the actual results. Okay, actual results. Actual results, when you compare with budget, you should get variances. Are you okay in this part? Variances represents your control cycle. Okay, variance represents your control cycle. This is your budget director here. Okay, now moving on. Analyze behavioral impact. Prepare financial forecast and address uncertainty. So sometimes you have situation in the future which is uncertain. You don't know what's happening. How to prepare forecasting for that? Analyze behavioral impact that result from budget. Now, whenever we do budget, remember, budget is a control tool and a planning tool. But when you control people, there's always this problem with human beings. What's the problem with people? Okay, always there's a problem with people. People will always have an issue. What's the issue with people? When you try to control people, there's always going to be something called behavioral issues. So you need to deal with the behavior issue. So when you try to control people, it's like, hey, do this, and all that. People will not react properly to controls. You know, if people reacted properly to control, everything in the world is easy to control. Got it? So control is not easy to achieve. How do you achieve strong control? Is an idea that everybody wants to figure out. Okay, and discuss usage of alternative budgeting. That's what you're looking at. Okay, this is subject model as usual. So budgets actually sit in the strategy conversion to operation. Got it? Right, so let's look at the introduction to plan and budget. So what are the ideas you can see here is this concept. Let's put this concept picture here. So over here you can see there is a relationship between budget and strategy. So we talked about this before. I already highlighted it here, correct? So you can see the strategy is the long-term plan, okay? Then become long-term objective to achieve long-term and operational plan. Now to become operational, obviously you pass through a tactical plan and operational plan. Now I do need you to understand the difference between strategy, where the company wants to go and what they want to be. Tactics is all the departments, like what marketing must do, what HR must do and everything. And then after that, operation is what they have to work on practically. So if you say the manufacturing department plans, those are tactical. Then the production, the labor and all that, those have become operational plan. Are we okay in this part? So they break down to lower parts. And this is what they mean. After that, you can prepare your master budget, which I told you. Once you have your operational plans, you can get your budgets, and then you should be able to create your master budget. Okay, so master budget, which is your financial budget, and master operational budget. Are we okay? So that's basically the flow that you see here. The next one that you see, budget is cross-functional activity. There are many types of budgets and different time periods for which a budget can be prepared. So we can prepare annual budget, weekly budget, quarterly budget, functional budget, event budget, project budget. So different budgets are set up. So when you make a movie, there's always a budget for the movie, yes or no? Okay, you do any event, there's a budget for the event. Okay, so a master budget is comprehensive initial plan of what the whole organization intend to accomplish for the budget period. So one of the keywords you got is something called budget period. How long you're budgeting? Okay, usually 1 year. All right, usually 1 year. Now, the operational budget is associated with operating activities or income producing activities, always precede the financial budget. That means before you can do the financial budget, you must do the operational budget first. So you must do your sales budget, you have to do your material budget, you have to do your labor budget, you have to do all of that first before you can do your financial budget. Does that make sense? So operations always apply first. This apply both to manufacturing and service. To develop within a constraint of limiting factors such as demand. So the most important thing about this operational budget, okay, is this idea that you have to use something called it's always based on limiting factor. What is limiting factor? That is the item that limit the business. So an operational budget start with limiting factor. So if you start your budgeting, you always say what is the limiting factor for the business. Sales is the limiting factor, so sales is your first thing you budget. If material is the limiting factor, material is the first thing you budget. Are you clear? No? So the first thing you budget is the limiting factor. After that, everything else fall in place. Let's say your sales is 1,000 ni. Then you start with sales 1,000, then production how much to meet the sales, and then the material how much to meet the sales, you know, and so forth. But let's say your sales 1,000, but you only have material for 800. So you have to start with 800, you cannot start with 1,000. Does that make sense? Okay, that's the idea of based on limiting factor. Clear? Usually sales. Okay, now financial budget is set of budgeted financial statement, provide forecast of the company's income statement, balance sheet, cash budget for the next financial year. So you have to have a forecast for the next year. Now, purpose of budget. What are the objective of budget? Well, I used to help manager, owner plan for future, formalize their goal. The budget process provide formal mechanism to ensure company objective activities are planned properly. So there is this formality, you know, formally doing it. So the whole process of budget, like, you know, government budget, company budget, all of that is like a formal process of setting up things, putting all the things in place. Now, budgets can serve as a benchmark to provide guideline for operation. So when you're doing your operation, you can say like, okay, this is the basis of setting the benchmark. Budget allow comparison against actual financial result at all level of business. So the word actual versus budget can be compared. You can evaluate individual level, department level, division level, entire organization. So this budget, you can do it at different levels. Are you clear now? You can do a budget for individual, can do a budget for department, can do a budget for division and a whole company. Then, cash should be taken not to make the budget the target that needs to be met, because when a measure becomes a target, it becomes a bad measure. It's not a good measure. Got it? So a budget shouldn't become a target by itself. This is one guy did a study. Remember, CPA has one problem. It just basically takes research from everybody and jumbles it in, and therefore starts to give ideas from everybody. But you must understand, every time somebody do a research, they get a different idea. So that's one of the problems that CPA has. Okay, but the concept of budgeting is still there. Okay, do remember there are 4 types of investment centers. Make sure you know the 4 types of investment centers. What's the 4 types of investment centers we are dealing with? Well, we are dealing with the revenue center, where you are responsible for sales or revenue generation. Cost center, you are responsible for the cost. Profit center, you are responsible for the profit. The other one is investment center. Okay, you got investment center, which is where the profit, your investments is basically the managers in charge of capital, profit, and also cost and your revenue. So everything. This is the different types of responsibility center. So you do need to know that when you're budgeting, that you can budget for 4 different types of centers. Okay, so not only the level here, you can also budget for different centers, responsibility centers. Are we okay? Now, moving on. Planning and control. Okay, budgets are a useful tool to help managers and owner plan for the company future. Multiple budgets are sometimes prepared that identify best worst case scenario. Okay, in terms of multiple budget being prepared for best worst case scenario, we can kind of do something called flexible budget. Okay, the concept of flexible budget So you can prepare multiple budgets, and the way we kind of prepare that is to use something called flexible budget. Okay, use something called flexible budget. So flexible budget approach might be easier to use. Got it? Easier to use. If we use flexible budget, how to do flexible budget? Okay, example of flexible budget. Let's talk about it. Analyze the adjust the variable cost, leave the fixed cost. Got it? Kind of means that you flex for the actual levels or the different levels. Got it? Okay. You flex for the actual levels or the different levels of operations. Are we okay? Okay. Now, the other issue here, when you are doing this one, let's say example, right? Can you calculate this one, guys? Okay, so if you got this one already, can you calculate, tell me what's the estimated cost? The estimated cost should be right. That's high-low method being applied. Are you clear now? So you can flex your costing around. High-low method is something you learned in your basic mathematics. Okay? And you studied in costing 1, costing 2, got it? And you forgot it. And you forgot it, which is critical because at this level you are year 4 student, you are supposed to be expert. That's the meaning of a year 4 student. Your knowledge is supposed to be near expertise level already. Follow? You don't want a low level FIA student telling you that they know better than you because they study the same stuff. Clear? So if you go into a challenge mode with some FIA students and then they ask you some questions and then you can't answer, then people start looking at you funny, right? They're like, hey, you're year 4, betul ke? Clear? Right. So you need to know your basic knowledge. This is basic knowledge. Are you clear? Now, can I move on? Okay. So ideally, using a budget as a means of control, the performance manager can be challenging. Okay. Ideally, budget should neither be too rigid or too this one. So you can do best or worst. Okay. It's common practice to use budget as a means to monitor, control companies' resources. Now, this is done by frequent, timely comparisons of actual results with budget forecast as reported as variance analysis. Financial budget help management to ensure organization remains solvent and sustainable. That's the purpose of financial budget. That means forecasting how much money you need, whether you got the money or not, and so forth. Clear? Okay. Now, using budgets as a means to control the performance of managers and employees can be challenging. Can be quite challenging. Ideally, the budget should neither be too rigid nor too slack. Clear? Neither too rigid, too slack. Okay, now we are moving. Do you know what's meaning of too rigid, too hard to achieve? Too slack means too easy to achieve. So how do we develop master budget? Okay, the idea of developing master budget, first thing you have to consider the impact of internal, external factor in the budget. So when you do your budget, the first budget usually develop is sales budget because that's the limiting factor, because all other budget depend on the sales budget. So you must get your sales as accurate as possible, because if you have inaccurate sales, the whole business is affected. You expect too much sales, then you believe got too much cash, then you do all your business according to that. You expect too little sales, then you, by the time the orders come in, you have no ability to fulfill because you never planned for it. So getting your sales correctly forecasted and adjusted is important. Just as important as getting the forecast for raw material, finished good inventory correct. So you need to know how much you're holding. Size of the company, whether national, international, affect budgeting. So when you are bigger, the more complicated it becomes. Like international company, they have to focus across the world. Like if you look at company like, let's say Cherry, Cherry, they are selling cars all over the world. They have to be able to forecast every location, how much to manufacture and prepare. Setting budget for international companies are even more complicated than the normal budgets. Okay, now the process of budget forecasting, you got something called sales budget. Okay, you start with sales budget, then you go to your production budget, then you go to direct material cost budget, then you go to your direct manufacturing labor cost budget, and your manufacturing overhead budget. So these are the three things that you prepare, which then comes to your finished good inventory budget. Then you can prepare cost of goods sold. Then you got all your sales costs, admin costs, all the other costs, which is called the period cost budget. Are we okay? Then only you have the whole operational budget setup. So this is the operational budget setup flow. Are we okay? Now moving on. When you prepare for non-manufacturing companies like retail, wholesale companies, don't make any goods, so they don't prepare production budget or any budget that relate to cost of goods manufactured. So they develop a purchase budget. There's no manufacturing, so they just straight away go to sales to purchase budget. All right. Now, service companies only prepare budget to forecast the revenue and the cost and expense relevant to those activities in rendering the services. Got it? So they will just look at how much they have to do for that service. Now, normally have a larger labor budget, extensive selling admin cost budget for service companies. Usually more higher labor. Sometimes also sell some goods like dentists or veterinarian. This organization might prepare a purchase budget and prepared by retail wholesale organization. Similar. So you need to know different type of company prepare different types of budget. You need to be aware of that budgeting process. Now, when we talk about financial budget, you break it down to the following aspect. You got the budgeted balance sheet, you got the budgeted income statement, cash budget. These are the three major ones. Then there's something called the capex budget, how much you're buying next year, what you want to buy, how much you're buying next year. Now, moving on, when you prepare budgets for different departments, remember, it's simply bigger and time consuming for decentralized organization. Remember, decentralized organization is same as organization that are centralized, but it's simply bigger and more time consuming for decentralized. Decentralized means got many division, many departments. Sales manager, rep of specific region, unit or town prepare their sales budget. Then the senior management job is to pull all the budget and aggregate them, bring them all and consolidate the budgeting process. Now, when you prepare a flexible budget, so remember the idea of flex budget is to study how sensitive is the revenue and cost for different level of activity. So they are useful to determine the worst, best and most likely scenario, which is what I told you. You need to know the cost behavior. How many costs are there? Variable, fixed, semi-variable. Okay, variable, fixed, semi-variable, you have to adjust for them. Semi-variable, we use something called high-low method to find out what is the variable part, what is the fixed part, then break it up. Okay, having budget for different scenario give valuable information for decision making. So if you want to make a decision like which level of activity, what is the situation, you can at least use flexible budget. Notice the word flexible budget means prepare for different scenario. Flex budget is adjust to actual scenario. Okay, I repeat that. Let's say I want a flexible budget. That means, okay, 10,000, 20,000, 30,000. This is called flexible budget. Got it? Then actual output is, let's say, 25,000. Okay, then I take my budget and I adjust to 25,000. That's called flex budget. Okay, are you clear the meaning of flex budget and flexible budget? There is a difference between these two. Now, although one budget will approve and be and adapted, flexible budget may be useful for coming year because they indicate different level of activity. So once you already make the budget, you set it, you allocate all the money for that budget. The next year also you can still use the flexible budget to adjust what is the level of activity. Now, there may be useful reference of probable outcome if planned activity levels are not achieved. So one of the idea you have to know is called preparing a flex budget. So the next part we are looking at is something called variance analysis and control. So when we do variance analysis, static versus flexible. Okay, what does that mean? Fixed budget versus the flex budget. Approved adopted master budget is based on forecast planned sales and determined at one level, which is called the static. We forecast 10,000 sales, alright? Actual sales could be 8,000. Are you okay? So you got forecast or budget 10,000, actual is 8,000. There's a gap between the volume already, correct? So, but many companies, the costs are variable and total cost changes in proportion to production level. So, when you compare actual result with static budget, it's not a clear because 10,000 units static, 8,000 unit is actual, correct? So, you can't really compare the two because the variance is caused by the volume difference and the variable cost that change because of volume. So in this case, when using variance analysis for monitoring and control, two aspects are investigated. You got the quantity, both sales and production, and the selling price and cost, got it? So you got the price element and the volume element that you need to adjust for. So to interpret variance, a flexible budget is developed. Now, you do need to know there are profit and revenue related variances. What are profit and revenue related variance? So when you analyze a profit revenue variance, both static and flexible budget are used. You use both. To determine sales volume variance, the contribution margin is used. So we always use contribution margin, but we can use gross profit also. Remember, you can use gross profit or contribution margin to determine sales volume variance. To evaluate the performance of sales manager, sales price variance is determined. You do have to link, there is a connection between the variances, that their causes is essential, meaning you increase price, volume will drop. You reduce price, volume might go up. So these are that price volume connectivity that you need to be aware of. Same thing like the raw material price higher because you buy high quality, the usage will drop. So there is like variances or link between the item. Clear? So over here, if you increase selling price, okay, why did you increase selling price? In other words, the causes of variance or why something happened. Now, if you increase selling price, you got favorable sales price variance. Write it down. Favorable sales price variance. If you decrease selling price, you got adverse sales price variance or unfavorable sales price variance. So, increased sales price variance, why? Maybe there's a shortage in the market. There is a higher market demand. Okay, there's a higher market demand. There's an increase in competitor prices. Okay, there's a lot of competition. The prices go up, or you want to adjust according to the competition. Organization may use superior quality of raw material, so use higher quality material. Therefore, you can charge a higher price. You improve the quality of the product itself, so charge a higher price, or you add extra features. So all this justify why your prices go up. Okay. On the other hand, why your price might fall is maybe there's a decrease in the industry as a whole. Could be because there's a decrease in demand or there is a new competitor enter the market. You have to fight with them, you drop the price. So that is increased selling price, reduced selling price. You have to know the causes for the variance. Okay, causes for variance. Now, when we are calculating a variance, direct material, direct labor analysis, it's not always obvious flexible variance how much relate to inefficient consumption of the raw material and how much relate to increased price. Got it? Now, flexible budget are further subdivided to show the price variance separately to the efficiency variance. So you have to break it down. So when you break it down, you get the price variance, efficiency variance. Now, I use the word usage variance for material. I use the word usage, but CPA uses the word efficiency for everything. Yeah, so they say material efficiency variance, labor efficiency variance, variable overhead efficiency variance. So they basically use the same word for everything. All right. Okay. Flexible budget, further different, similar to analyzing price efficiency variance for direct material. Price efficiency variance for direct labor are useful to evaluate production managers' performance. So you can break it down. So here you can see AQAP, which is what I gave you before. Now they use AQBP, budgeted price, also known as the standard price. Are we okay in this part? BP is the budgeted price or standard price. And then you got BQ allowed for AQ, so the budgeted quantity allowed for the actual quantity, or we call that standard quantity. Got it? How much you should use for the actual units. Standard quantity times standard price. So I have modified this formula. Don't worry, CPA doesn't mind that you use different variations, but you will have this idea in your head, and this is the way they analyze it. And if you've seen the table I gave you last class, I was analyzing it this way, I was preparing it this way. Got it? Right. Do be aware, variable manufacturing overhead analysis, you also have something called variable overhead, fixed overhead, yes or not? These things also change. So you are talking about indirect material, indirect labor. These are all part of variable overheads. Got it? Variable overheads. Overheads are all indirect costs, yes or not? Overhead can be fixed, can be variable. Okay? So in this case, you got indirect material, indirect labor, utility, engineering, machine maintenance. All these are called overhead. Now, the overhead can become favorable variance, adverse variance also. So when you have a look at it, reason for variance. So you can see here, favorable price variance and spending variance, favorable efficiency variance, unfavorable efficiency variance, unfavorable spending variance. Okay, the word they use is spending variance as opposed to a price variance. Got it? Spending variance and efficiency variance. So spending variance may be favorable because you got talented junior staff who can do the task of higher paid staff. You got a lot of negotiations with your purchasing manager. You got oversupply of raw material. Now, which raw material? We're not talking about direct raw material. We're talking about indirect raw material. Okay, there's direct cost, indirect cost, yes or not? So indirect materials might have been cheaper to buy. Buying the raw material in bulk, maybe lower price. Maybe you change supplier with better prices, or you use cheaper substitution, or you got better financing decision. These are all the reasons. These reasons can be used for material, labor, variable overhead, spending, fixed overhead spending. So all of this generally can use the same ideas. Got it? Then on the other side, you got favorable efficiency variance. What's going to be the reason why you're more efficient? Maybe your worker is more skilled than the normal one you would use. That's why you're more higher efficiency. Your scheduling is better. You have better scheduling, so you use your worker better. You got improved production scheduling software installed, so that might improve situation. Or you use higher quality raw material. People find it easy to work with the material. Now, you got unfavorable efficiency variance because maybe you use less skill than what you expect. You have unskilled workers that have to be used because of unexpected event. You got inefficient scheduling of job, machine not maintained properly, the machine break down regularly, or you use lower quality raw material. Again, these are all possible causes of the variance. Are you okay? Last one, you got unfavorable spending. Maybe you hire very experienced staff, you pay higher. You pay higher because you're more experienced. Maybe your staff, sales staff promised rush delivery, so you have to work overtime and rushing everything to pay everything. Or your staff underwent training, obtained qualification, got promoted, so they have their wages increased. Or there's a short supply of raw material, that's why your prices went up. So basically, when you have an unfavorable, favorable variance, you have to discuss what are the possible causes. And this is normally one of the exam questions. They give you the variance. They say like, okay, what do you think is the cause? Is this, which one of those most likely explains this issue? Okay, right. So that covers this idea of variances. Then finally, you got fixed manufacturing overhead variances. Now, I already gave you the formula for this also, correct? I gave you the formula for this. Fixed manufacturing overhead cost variance, slightly different from variable. You got sales production volume do not affect fixed manufacturing overhead within a relevant range, so no efficiency is calculated. Example of your fixed overheads include your depreciation, leasing, plant manager salary. That means there are two ways to calculate fixed. You can use the absorption costing or the marginal costing. If you use marginal costing theory, you do not calculate a fixed overhead efficiency variance. But if you use absorption costing theory, then you will calculate a fixed overhead efficiency variance. Are we okay in this part? Depend which model you're using. Is it the absorption costing or marginal costing? The next area we're looking at is the behavioral aspect of the budget. What is the major behavioral aspect? So when we say behavioral, is it a participative budget? Do people get involved in the budget regularly? If people do get involved in the budget regularly, that's called bottom-up approach. So people from the bottom do get involved and tell you what they think and how the budget should be. Top-down is where the board of directors set the budget and pass down the budget. So top-down got advantage, less time-consuming, more cost-effective, but there is a problem. Senior manager may not have knowledge about what's happening down there, so they go and set things that cannot be achieved. The lack of involvement with low-level manager may lead to commitment. They may not be so committed to following the budget, and setting high target to encourage improved performance might be discouraging people. Set too high target, they cannot achieve it. On the other hand, bottom-up is where the idea comes from the bottom and they tell the senior management what they want. In this case, it encourages coordination, communication, create a sense of responsibility and foster creativity among all the staff. Okay, so people will be a bit more creative. Provide greater understanding of the organization objective, what they need to achieve, and so forth. Now, the disadvantage can result in dysfunctional behavior. That means they may do what they want rather than what is good for the company. That's called dysfunctional behavior, and may result in pseudo participation or budgetary slack. Pseudo participation is just like I'm there but not there, studying but not studying. Those are called pseudo participation. Okay. Budgetary slack is like putting in extra when you don't need it, like adding more cost in when you don't need that cost, just in case you put extra in. Are you clear? That's called budgetary slack. Other issues, you have to set realistic and achievable targets for the business. Now, when we say set realistic and achievable target, now to mitigate negative behavior, the practice of setting unrealistic budget, the challenge is to set a more realistic budget, something people can achieve. Okay. Now, avoid using budget as a means for rigidly evaluating performance. Instead, give some discretion when you compare performance. So you cannot use budget so tight. You use budget very tight, people get demotivated. Okay, they cannot feel happy. Now, you give rewards for achieving accurate estimates. If people give good estimates, you should give them rewards. This align goals, incentive, give everyone who achieve their goals an incentive to achieve that thing. So that's the meaning of benefit of setting realistic, achievable target in your budgets. You also need to know about monetary, non-monetary incentive scheme, meaning your reward scheme. How you reward people for the budget might ensure this idea of goal congruent behavior. The word goal congruent is everybody have the same goal. Everybody aim for the same goal. Then you have goal congruent behavior. Now, monetary incentive can be used to motivate people to be more productive, work effectively, and reduce waste. Monetary include your salary increase, your bonuses, or your promotion. Non-monetary is something called intrinsic or psychological behavior. You studied this before using Maslow hierarchy of needs. Remember Maslow hierarchy of needs? Self-actualization, self-esteem, and all that. So this is the self-esteem, job satisfaction from being given responsibility, challenge, autonomy, recognition. Meaning, sometimes people feel more valued, they feel they're happy because they're given complicated and hard job. Are you clear? This is kind of tricky for you because you feel given more job is actually a bad thing. But actually given more job is supposed to be a good thing. Alright? Okay. Now, the right balance of incentive should be struck to ensure employees aspire to meet short and long-term goals and deliver the best possible outcome. So you must make sure your reward scheme is balanced properly so that you take into account long-term goal, short-term goal. The last one we have is something called alternative approach for budgeting. What are different ways of budgeting? So what are different ways of budgeting? Well, one of the problem with budgeting itself is it imposes central planning and decision making. That means HQ do everything, the big boss say everything, you follow the boss. Now, a costly method, very costly to do. Stifle initiative. Initiative takes, that means people don't come up with new ideas, they just follow. Impede empowerment of employee for making best decision for company. People have to follow what's in the budget. They cannot make decision outside the budget. So they are constrained by the budget. Restrict company ability to act and react. And finally, Hansen basically says that they did a research, they found out having budget is very time consuming to put together, not easy. Constrained response, because people cannot respond to changes in the market. Budgets are rarely strategically focused, often contradict. That means they say like, what's the strategy and what's the budget is two different things. They don't work together well. Budgets add little value given the time required to prepare them. You prepare a lot of time but don't really go through it in detail. A good example is like Malaysian government budget. Every year they prepare but they don't review it and discuss the variances. You don't see a strong budget review discussion at the end of the year. It's just like, let's set the next budget, nobody is reviewing it and saying how well did we do, where did we do wrong, who's being held responsible. No such discussion. So that's kind of a sad story of why use the budget in the first place. Clear? Then you got budgets concentrate on cost reduction, not value accretion. This is a very important idea. I told you accountants are always looking at how to cut costs, correct? They don't look at how to add value to the business. Clear? They don't look at how to add value. Like one guy was saying, they spent about $6 billion or something to make the train from London to Paris to go faster, or some European train to go faster. Faster. They spent $6 billion to make the journey time from 3 hours 30 minutes to 2 hours 30 minutes. Now, another guy is saying you'll spend a lot less money if you make the journey more enjoyable. People won't mind the extra 1 hour. So you understand the idea of value adding and efficiency focus. So value adding is sometimes qualitative things are value adding, but you cannot put a number to it. Sometimes you spend too much on the number part of it. That's the idea of budgets. Budgets tend to be very number focused. Now, budgets strengthen vertical command and control, meaning its budget is aim is like CEO tell you what to do. Got it? Command and control. Budget do not reflect merging network structure. Current structure, that means the current companies, they don't operate like a normal department. A lot of things might be outsourced here, outsourced there. In that sense, because they outsource everything, they may not be really needing a budget which is designed for the department approach. Then budget encourage gaming and previous behavior. Gaming, that means people try to manipulate and set different targets and try to cheat the other managers to get money and so forth. That's called gaming. Budgets are developed and updated too infrequent, usually annual. So when you set annual budget, a lot of things happen during the year. You don't update, it gets outdated and useless. Budgets is usually unsupported assumption. A lot of guessing, like if I tell you how much is the sales next year, you just like guess a number. I think this one we can achieve. So that's guesswork and not really supported assumptions. Budget reinforce barrier for departments, and rather than share knowledge, people will lock knowledge together, and budgets may make people feel undervalued. This is the problem with budgets. Are we okay? Now, moving on. Incremental budgeting involves projecting next year budget by either adding an adjustment. This is a normal way. You add an adjustment to the actual result or the previous budget. You just add for volume change and also for inflation change. That's the adjustment. It's fast, okay, easy, useful for small businesses like service company because they have a simple business model. The big disadvantage is the manager may not plan appropriately for the future because they just keep adding and adding and adding, which is what they do in the government department. They do incremental budgeting. They tried to introduce zero-based budgeting. It failed on the spot. Nobody wanted to do it because it was too scary. Okay. Consider strategic operational plans. So the disadvantage of this, it doesn't align with any strategy or operation. And carefully consider effect of internal, external factor. A good example right now, look at the amount of AI development in the market. Should the schools continue going on and say like we have to keep AI out of the school? So sekolah menengah, sekolah rendah have kept AI out of school, no phone, no nothing, this. And then the technology is already going so far in advance. Because there's a gap, the way the budgets are done, incremental, they don't want to do anything new, they just continue doing what is old. Can you understand this part? So this is an example of how things are changing, clear? Now, may result in complacency, dysfunctional behavior or waste of resources. This is the problems that come up because of incremental budgets. The next one you got is zero-based budgeting. You start from zero. You design sales package. That means you say like, okay, you are a department. Let's say you are a department boss. You want to ask for budget. Then they say, okay, what's your value? What you want to tell me for the budget? They say, okay, to do basic service, I need 2 staff lah. 2 staff salary, 1 machine like this, like that, I can do basic service. You may do a bit more better, then I want 5 staff. So you give them packages. You prepare packages and you offer the packages to the board of director, saying like service 1, service 2, service 3, service 4 package. Each level higher. Maybe service 1 is 10,000, service 2 is 20,000, service 3 is 30,000, you know. So you package, and then the board of director will choose the service they want. That's called zero-based budgeting, based on your justification. So every year you must justify what you need. Are you clear now? You start from zero. So the manager prepare budget as if no information about revenue cost from previous budget cycle is available. Budgets are developed from scratch. Force manager to consider internal, external factors clearer. Very time consuming, very expensive, and because it requires a lot of in-depth analysis of all expenses. The next one you got is something called activity-based budgeting, ABB. ABB starts with ABC, activity-based costing. Are you clear? So activity-based costing. Once you have your activities, then from your activities you build your budgeting. Are you clear or not? You first start with your activities that you need for the business, and then only you build your budgets. And therefore you must know your cost driver and cost pools. Those are ideas you have to be aware of. So basically the concept is you start with your activities and your resource capacities, then it comes all your activity budget down here. So from the activities that you need, you go to your resource and adjust your activities accordingly. So you can see the activity budget is driven by the activities needed for the operation budget, sales forecast, production activities. Then you come to your financial plan. Got it? Now the activity is improved by investing on machine. Like, you know, if you want to improve your machine ability, the activity is machine hours, then you might have to invest on your machines. Are you clear or not? If the activity is like maybe store department, then you have to make your store bigger or something like that, then you invest in the store department getting bigger. So that's that capital one to assess your resource capacity. Now moving on, right, the last idea is called beyond budgeting. What is beyond budgeting? Beyond budgeting is simply focusing on this concept where you don't want budget anymore. There's no more budgeting being used. It's a contemporary management model where company manage without budget. It's based on 2 different ideas. One is called decentralized leadership. All the division do themselves their own budgeting and their own plans. And adaptive management process where the division can adjust very fast to whatever that's happening to them. And the board of directors also adjusts very quickly. So beyond budgeting is a different thinking pattern, different way of doing things. Budget are still developed, but not as a target or performance evaluation. It's more like a aspirational tool. Like what's a budget? It's just for aspiration, just for motivational purpose. No longer for control purposes. No longer for making plans and all that. It's more like, can we achieve this? This is like goals for you as opposed to developing a budget for planning and control. Got it? Has not been taken up widely across the globe, possibly because it lends itself to coaching management style, so it requires a lot of change in the management philosophy. This beyond budgeting started in 1970s, it's not been picked up yet. By the way, budgeting itself started when? When is the idea of budgeting started? Well, the concept of proper budgeting, the one you're studying right now, was started in 1940s by the DuPont company working together with Harvard during World War II. So this budgeting idea itself is from 1940s. It's now 2025 and we're still using something from the 1940s. There's something developed in 1970s, also not popular yet. ZBB was developed by 1975 in Texas Instrument by an American company. So there are different companies who actually created this whole process that you're studying. Clear? It's not done by researchers or academics, but we can say Harvard was involved. Harvard University was involved in everything that you see here. All right?